to a really great financial future. Tom and Don are talking real money.
You guys should just be here for the pregame. I should just hit the record button for the pregame show. Because what the stuff that goes on that we talk about before the show, we like argue, just and you know, it would make the perfect pilot for two white guys waiting around to die. My idea for our next podcast. It's got to be two old white guys waiting around to die.
I'm sure there's a lot of people just sitting around waiting for that show to be rolled out any moment.
Yeah,
so,
but the thing about that show is that it would have to occasionally have that little Apple brand legitimately attached to it. But one of these days, without telling Tom, I'm just going to hit the record button, and I don't know what I'm going to do with it, but
but won't be on this channel.
Wait a minute, maybe we can get people to pay for that podcast.
Oh, yeah, sure. The insights, the
nobody
arguments.
pays for this.
Yeah.
In fact, we even took the commercials away, and nobody said a thing. Like,
I know, so weird.
Thank you for taking away the Talking Real Money commercials. We took them away. We went, you know what? It's incremental dollars, and it's annoying. You know, it's just annoying. It's not. There is very little money to be made in podcast advertising for your typical, and we're a top 1% podcast.
I know.
Top 1%. My lit reading podcast is top 10% of all podcasts. You know what that makes a month?
Is this the partial penny thing, which you're still trying to figure out how to pay?
No. That lit reading makes a little more than Amazon books. It makes about $200 a month.
Hey, look, $200 a month.
$200 a month.
That pays 1/8 of the heating bill in the summer or something.
I got to tell you, I'm making less than minimum wage putting that podcast together.
Yeah, but it's the glory of having your own
No,
podcast.
actually, it's the love of the
podcasting.
Well, and for lit reading and all of my other short story podcasts, it's really truly the love of the storytelling. I get a kick out of telling the story. And I love these stories, which is why I started writing stories, because I was just going, wait a minute, if these old dead guys can do it, I can do it. I'm still alive. Okay, Barely. They were alive when they did it. Barely. I'm an old white guy waiting around to die. Welcome to Talking Real Money. Now we get to the money part. 2 minutes and 30 seconds in. That's my coaster. It's my gavel. I'm going to gavel this proceeding to order as we today talk about risk.
Yeah, I thought you were going to gavel me down, so I'm happy to hear that.
Order.
I'm not being. I thought that was coming. Fascinating times in stock and bond markets. We'll get to bonds.
Wait a minute.
Another day.
More fascinating than usual?
I think so. Goldman Sachs estimated this week that retail trading volumes are up about 30% in the last month. 30%. Now, they don't say what they're trading, but they're trading more stocks, more retail, the big names, the meme stocks.
Wait a minute, we're talking about stock trading or just overall trading in securities?
Stock trading. Yeah, stock trading. Stocks. And if I was a betting man, you know that I think the AI trade is still on.
I would be betting that most of it's the AI trade.
Yeah. And what did
There's probably some energy trade, but who knows whether that's legal or not.
Good Lord, let's not go there.
I mean, go there.
You know what's coming next.
I know what's coming next if I go there.
Yeah, I can read them too.
$1.8 billion.
But this is fascinating.
Did I say that out loud?
No, you didn't say anything.
I didn't say that.
A fascinating topic because we watch this fairly closely. You know that, for example, today it's somewhere between $1 out of $2 invested in index or index-like products. About half. Right? Mm-hmm. 20 years ago, or maybe 25 years now, it was $1 out of $20. So think that through a little bit. There's been a significant number of people who have just said, you know what? I'm not trading. I'm not buying actively managed funds. I'm just going to take what the market gives me.
And we have been predicting that change for as long as we've been doing this. We felt that this was the inevitable direction, that indexing and low costs and all of these would eventually, as people learned more, would become more prevalent, and they have.
But on the other side, on the other side,
there's always a big fat but, isn't there?
I'm going to let you say that. Here's to me, you can still, by the way, you can still be index fund investor and take significant more risk. But FINRA, which I don't know, I didn't know
the
they're in the
Financial
business
Industry Regulatory Authority.
I didn't know they're in the business of publishing reports, but they published one a poll about investor attitudes by age, right? By the age of the people surveyed. So a third of those surveyed, in the total survey, a third said they need to take, and this is a quote, big risks to reach their financial goals. But that rose to 62%, so 2 out of 3 people for those under the age of 43. Some 43% of that youthful cohort reported trading options compared to less than 10% of those 55 and older. This is fascinating to me. First of all, that people think they need to take, a third of people believe they need to take big risks to accomplish their financial goals.
The devil, though, Tom, is in the details. That's really risk. We agree. You need to take risk to make more money than just the safe money rate, which is right around the rate of inflation plus maybe a smidge. That's all you're going to get is a smidge. To do that, you've got to take risk. But here's the thing we need to do, and this is the thing we learn, and it's the difference between those younger investors and those 55-plus investors. You learn over time the differences between various types of risk. There's good risk and there's bad risk. There's smart risk and there's dumb risk.
Yeah.
And when you're young, you tend to be a little dumber. And by the way, you'll agree with me when you're older. You'll look back
they won't
and go,
agree with you because you won't be here to agree with them.
Well,
but,
you will agree with the things that I said while I was still here. When you get here, you'll go, God, I was a lot dumber than I thought. And when it comes to the, quote, investing that many of these young people are doing, like options, like IPOs, like chasing hot stocks, this is all the kind of risk you take in a casino or the kind of risk old guys in the movies used to take at the horse track or the dog track, or the kind of risk that people take when they walk into a convenience store and get a strip of scratch-offs. This is dumb risk. This kind of risk is dumb risk. Yes, you can win big, but the odds don't favor it, because this kind of risk is a zero or a negative sum game, whereas the kind of risk we're talking about, where you take advantage of returns that the markets have historically delivered over time for very logical, sensible, academically researched reasons, that's smart risk.
Yeah, but let's just, out of curiosity, the 43% that reported trading options, how long are the odds? What percentage, of people that trade options are successful? I think we've done
the
this.
number. I think it was 10%.
It's a small number.
I can look it up, but I think it was.
While you're doing
10%.
that, I'll talk about, because you mentioned a few of these, but a few of the things that are not worth the risk, haven't paid off, might, but as you said, it's a gamble. Individual stocks. The odds are stacked against you to pick a company and think it will outperform. And now people in the Northwest are going to say, no, I bought Microsoft 30 years ago. I'm very happy for you. It worked out. It could have been Washington Mutual. And you're going to say, well, that's a wild example. No, Dr. Bessenbinder has showed us clearly that only 4% of the stocks make more than T-bills over the long haul. And some of them end up by the wayside. So individual stocks have not proven worth the risk. Number 2, timing markets, right? Moving in and out, buying things, selling things, thinking you see the future, heard something, got to trade something. Timing has not proven worth the risk. Number 3, sector bets. Boy, this is, right now, look
so
what's
far
going on.
you're going down in risk, though, with each successive one of these.
Well,
they're less. The first one was the most risky.
That's true, because you could lose it all.
Yeah,
it could all go away. Trading options, you mentioned crypto. People are going to say, "But I've made a lot of money."
Okay.
Have you?
Have. That's past tense.
Exactly.
Congratulations.
So these are things, and we'll talk about the ones I think are worth taking the risk, because you mentioned them slightly. But did you find the percentage of people,
Yeah,
for
I
example,
definitely did.
make
and
money?
It depends on the study. There have been a whole bunch of studies done of all kinds of data from the brokerage firms, and the number comes in at around 90% of active options traders lose money.
And yet there's
And
half of
wait,
young people.
those who make consistent market-beating risk-adjusted returns, less than 5%. It is a tiny, tiny
Risk
number.
adjusted will take it down a lot. Yeah. So those are the things not worth the risk. I'll tell you a few that are. And if you're a young person, this really plays to your strength. An all stock portfolio. Have no fixed income in your portfolio, or cash for that matter.
That's risky.
Yeah.
But that's smart risk, because this is what underpins that. When you own a massively diversified portfolio of stocks, which we prefer, you own a proxy, or at least something very similar to the entire global economic output. That's a thing worth betting on, because we know that over the past 2,000 years, the global economy has grown more valuable, and by a pretty decent number, if the historical record is to be believed, and it's a historical record because it's historical and recorded.
Yeah.
So it should be
not every year. Not
every
all the
year.
time.
No. This
Nope.
is
Exactly.
in aggregate over a long period of time. The economy today is worth more than the economy of 26 AD.
Yeah. Which
The global
is
economy.
one of the Don being one of the few people who can remember the economy then. So that's one. Number two, and again, this is they're going to get argued. People are going to argue, but the academic tilts, owning more small companies, owning more value companies, owning more profitable companies, momentum stocks, things that most of them are fairly, I think, intuitive, but some people, wait, those are lousy companies, value stocks. Yeah, but we suspect over time that they will grow, their price will reach what the actual worth of the company is when you add up all the assets. So academic tilts, I think, is a very reasonable risk to take. And then here's another one, being more efficient. I'd looked this up. Today, there's about $20 trillion in savings accounts, most of which, every once in a while, Don's kind enough to look it up, what his bank pays for saving was pretty small.
I haven't moved because they've hung in there.
Yeah, I think they haven't moved from the 0.1, which if inflation's running at 3.8%.
You're talking about my Bank of America bank.
Yeah, exactly.
I thought you're talking about my high yield savings.
No, that's still paying.
That's
paying
paying
3.5 or
4.
something. Yeah, okay. So, but that's
4.
what I'm getting
It's
to.
still, 4.
That's another risk worth taking. Making money on all of your money. And you can do it in a high yield savings account. Don just said between 3.5% and 4%. You could make it owning bonds. You could make it owning CDs, but doing something, because being inefficient, letting that money sit around, the Bank of America is paying you 0.1 and inflation's going up at 3.8. Well, you can run that number and you're not doing well. But that's another risk, because you could say it's riskier to do, bonds, for example, than having it all in cash, because there's some variability of the portfolio. But those would be things, the risk, I believe, is worth taking. The other things, no, there's no track record. In fact, the track record, as we pointed out, is quite the opposite. And so taking more risk, yeah, but I like the word you used, Don, smart risk makes a ton of sense.
Yeah. And by the way, just for all you trivia buffs out there, who were the two major emperors of the two major empires in the world? There were two major empires in the world in 26 AD. Name the two major empires. The two major empires. What were the name of the two major empires? Rome and was the other big one?
Not Greece,
big.
I don't think.
China, dude.
China. You always forget how big China was, and then they weren't. Now they are again.
They were huge. This was during the Han Dynasty. They were, man. The emperor of Rome in 26 AD was not Caesar. It was not Augustus. It was Tiberius.
Oh.
Uh-huh.
Yeah. I don't know my classic history that well.
And then in
Yes.
China, how about China? It was
I don't know who was running the place.
It was the Han Dynasty. It was Guangwu of Han.
And the point of all this would be they took a lot of risk, or what's the deal?
No, it would be like 2,000 years ago, the economy was smaller than ours, but it's interesting that the two major players are basically there are two major empires then and two major empires now. Great similarities.
Oh, I see where you're getting. Okay.
Yeah, anyway, kind
Historical
of interesting.
comparison.
I just thought it was interesting 2,000 years later. Anyway.
Good.
If
Good
you don't think it's interesting, then change the subject. And you know how you change the subject? You ask us questions. And we have a brand new Talking Real Money website, ladies and gentlemen. Simpler, easier to use. The podcasts are right there on the front page. On the right-hand side, all kinds of stuff there. Easy, laid out. Anybody can handle this website now. It's so simple. There's less garbage behind the scenes. It's all cleaned up. And right there, you can ask us a question. You just type it in. Or there's a little microphone. It's even easier to speak your question. There's a microphone in the lower right corner. You click that and you record your question. That goes on the Friday podcast. But if you type them, Tom speaks them on the show, or he loves collecting paper, or he actually, he gets on the phone with you.
I
found these cool pins, these new Energel
Yeah, I stole
pins.
a bunch from here. Oh, those are nice. Yeah.
Well, guess what? This is what's cool about them. I'm going to use them for book signings. They're
big and thick and wide.
Well, they're really easy to write with, and they dry really fast. But they come. Look at the color of the ink. It's green.
Ooh.
And that one is brown
Yeah.
ink. Perfect for signing a Civil War book. You see?
I love it.
They're really nice. All right, let's go back to it. There you have it. Look at that. Look at how simple that was. And it's so much easier than calling on a Saturday. You don't have to schedule. It's all easier if you do it this way. Tom takes most of those calls. Once in a while, I'll do one. And then if they don't end up being in a conversation, if we don't think they need that much time, then Tom just picks up the paper, reads the question, and we talk about it like we're going to do right now. Right?
Yeah, and this
Tom?
question comes from Hendersonville, North Carolina. Thomas.
That is right next to Asheville. I love Hendersonville.
And Thomas, you're going to get, if it's Thomas, you're going to get your question answered. You can be pretty sure of that.
Yeah.
Says, hey, Don and Tom, greetings from North Carolina. Yeah. I love the podcast and hope you're both doing well. We are. Thank you for that. I am 58 and recently retired. 58?
Get back to work and be productive, darn it.
Jeez.
Come on. What are you going to do? Sit around and you can only enjoy the mountains for so long,
I have a Boglehead 4 fund portfolio in a 60-40. I'm assuming that means 60% stocks, 40% bond, and it has served me well. He gave the tickers VTI, VXUS, VCOBX, and BNDX. Like a lot of folks, the overvaluation and speculation on the growth side of the S&P 500 has me concerned, as well as inflation.
Oh, stop it.
Saying the market's
I know. This is the problem. It's feelings that get us into trouble.
So I wanted to get your thoughts on two questions since I'm no longer in the accumulation phase. Number one, should I consider adding a value factor in addition to VTI?
Yeah. Yeah, you should.
The question would be how to do it and keep your for fun thing. You'd have to add another fund.
You wouldn't. You'd have to have a fifth fund.
Yeah.
If you're staying with Vanguard.
So, for example, just for sake of argument, because with VTI, VXUS, again, large index funds meant to hold the whole market, but you're in our mind would be underweighted to both small and to value. So here's an idea.
See, that's why I would use a small value, just
Correct.
Sneak a little in.
Yep. So maybe you take, of the 60, right now you have the two funds. I don't know what your division is between U.S. and international. But if it was my money, I'd put a third in AVUV, a third in VTI, and a third in VXUS.
Okay, or if you want to keep the Vanguard.
Simple.
If you want to keep the Vanguard.
Yeah, you go VBR then.
You just add a fifth fund. You slice a little off of VTI, just a little, because the small cap value is U.S.
That's right.
And you put in a little, maybe 20% of your equity position of the U.S. equity goes into VBR.
Yeah, you could do it that way.
And that gets you value and get you small because you're underweighted in both of those in this portfolio.
Number 2, in addition to VCOBX, which is a bond fund, I believe.
Yeah, it's and it's funny. It's
don't
like
use it, but yes,
it's like BND.
Sounds like it.
It's the Vanguard Core Bond Fund.
How many of these things they have?
This is Vanguard. Vanguard has way too many choices.
Is this one of those ones going to be relabeled Morningstar, Vanguard, et cetera?
I don't know what.
In addition to that, should he consider adding
good quality stuff? But it's
tips.
Basically BND.
Yeah, tips.
You got stocks. You see, you've got stocks. You don't really need tips. It's one of the lovely things about stocks is that they have been pretty good inflation hedges.
They've been the best.
Because companies raise prices in reaction to rising costs. They respond to those. And that gets built into the prices over time. Remember, it's a longer-term thing, and you can't get caught up in the day-to-day minutia or the day-to-day feelings.
Well, I was going to get to that because, again,
the market's a long-term thing.
It is. You're looking at this saying, I'm worried about the growth side of the S&P 500. Me too. But that doesn't mean I can run out and make a move because I don't know what's next. I would be balanced between growth and value all the time. I would have exposure to small continually, both U.S. and international. He also asks, what about a fund like VBIL? Or should he go through Treasury?
I don't even know what VBIL is.
That's a short-term
VBIL.
T-bill.
Oh,
T-bill
gosh,
fund.
that's a 0 to 3 month.
Yeah, very short.
Okay, that's like money market.
Cash. Yeah. No, would be no to that. No.
And I don't even know what it yields. Let's look at VBIL.
It's still probably yielding, I bet
less
it's still
than
yielding
4, I bet.
Oh, but maybe 3.25.
Let's look because you can get 4. You can get 4 on short-term or liquid savings. Right. Where's the current yield? 3.58.
Okay.
3.58.
I'm getting more.
I'm getting more in an FDIC insured savings account. A high yield savings account. Why would you want that? It can fluctuate in value a little bit. It won't fluctuate much. But it doesn't do much for you. I have this feeling that sometimes, maybe this is the problem. You retired, you're bored, you're overthinking this.
Can't you cut your lawn instead or clean out the garage?
No. Ooh, those sound like terrible things to do.
All right, so back to...
Go drive the Blue Ridge Parkway again for like the 400th time.
First of all,
by the way, I love the Blue Ridge Parkway. God, it's a great drive. You've never been there, have you?
No, I never have. First of all, your portfolio's okay the way it is.
Yeah, it's okay.
But I would fix the equity side. I probably wouldn't mess around with the bond. I don't think either of those funds are a big change. Mm-hmm. Those are okay. I'd fix the equity side. 60-40 sounds good. I mean, the only other thing I'd be worried about at 58, that could be one really long retirement. So I'd want to run the numbers very carefully to make sure that you're going to have the assets. That's a long time.
I tell you, to me, it's not just running the numbers. Maybe I'm just weird.
I meant to ask you this because now
I don't know what I would do. I would write, but see, that's not being retired. I would write more. I would read more.
I was going to ask you that. So because, as you know, I'm closing in on the end of your wonderful book on the Civil War et al. And I'm reading it. You have a lot of stuff in there. Specifically, like about the town, and this has this, road and blah 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 blah. So, how did you research all that?
Looked
how much
it
time?
All up.
How much time did you spend on all that?
There's a lovely, lovely thing called the internet.
I know, but so how much time did you have to spend on all those topics? There's a lot there.
Well, I've been working on the book for full on for like 6 months.
Okay, I didn't know.
For a
I
year.
didn't know. Yeah,
I didn't tell anybody. Here's what my wife was going,
Why?
you didn't tell me you were doing this. And I went, there's a reason. You know me.
First of all, if you tell your wife it'll be on Facebook in 10 minutes.
I have all these ideas. I have all these things that I think I would like to do. And sometimes they're successful and sometimes they're abject failures. And so in this case, because I didn't want to say, I'm going to try writing a book, and then it turned out to suck or I didn't write it or whatever, I just wanted that to be a quiet failure. And I forget about
the book is outstanding. The writing is great. The research is tremendous.
But
I was getting to that. So
I didn't want to tell you guys I was failing. So what I did to make the time. You see, that's one of the things about working. If you want to make the time for something, you gotta kind of give something else up.
That's why we're not talking as much as we used to. Okay.
That's why we what?
That's why we're not talking as much. Okay,
we talk every day, 2 to 3 times
painful
a day.
Okay.
Debbie goes, you talk to Tom more than you talk to me. I said, well,
it's easier.
It's those baggage there.
Exactly. But the book is great.
Okay, thank you.
And yes, for those of you who have any interest in America, in American history, or in Don's great-grandfather, which is
it's a fictional version of my great-grandfather.
Okay, but I happen to know the backstory. But it's terrific, really, really good book. So, and I've read, as you made people know, a lot of books about history and fictionalized.
Oh my God,
history,
it's all you read, practically.
That is all I read. So I've read some really good.
Yeah, it's called The Line Uncrossed. It's at bookstores everywhere. You can also, if you want, get a copy of it, an ebook copy of it, along with 3 other stories that kind of go with it. 2 other short stories I wrote from that same Line Uncrossed universe. I wrote one about his friend Pollard. Have you gotten to Pollard?
Yeah, that's the next chapter, I think. Yeah.
So I wrote a story about Pollard, and I wrote a story about Captain Wurz, the commandant of Andersonville.
Haven't met him yet, but we're right there. Yeah.
Then I included a short story by Ambrose Bierce that was brutal called Chickamauga. And so I put those in an ebook along with that, so you can get the Line Uncrossed ebook and the 3-story ebook.
That's for 2 great $5 tastes for one.
At donmcdonald.com.
That's good. Yeah. Okay. If you want help,
that website's named after me.
Shocker. If you want help with your money issues,
I have an idea. Go to that new Talking Real Money website.
It's beautiful.
And click on Meet an Advisor.
Yeah.
Just click on it, and it takes you to a little form you fill out. And then, honest to goodness, this is something we've been doing for over a decade.
Almost 2 now.
Almost 2.
Yeah.
Helping anybody with a, look at your portfolio, little, like, are you on track? Are you going to be in where you need to be when you retire? Or are you there now that you're retired? And we do this truly, 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 truly. It's not one of those fake free consultations where it's just a sales pitch in disguise.
Come on.
It's not that. It's not. It's real help. In fact, sometimes Tom does these things.
Yep.
Probably too often. You should really let some of the other advisors do it, but he likes it.
Yeah.
So do that. Ask your questions. Visit us anytime at talkingrealmoney.com. Listen to the podcast 5 days a week. What else do we need to tell people?
I think that just about covers it, sir.
Okay, sir.
Yeah.
Well, thanks for hanging out with us for a while, and let's hope you do it again because, as I said, we're here almost every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.